Uh, okay, sir, we will start. I just wanted to highlight a quote which I read in the morning today, which is that losers average losers. So, uh, we have seen over a period of time all the people who kept averaging Yes Bank and such stocks, they have lost money and they continue to lose money. From 300, 200, 100, 50, 10, 20. You will never make money, and so it is not good to average losers. Okay, so as I see the setup, there is going to be a Fed rate hike next week. The US corporate results are good, especially the large corporate sector, like that is the tech stocks and the bank stocks. Uh, Bond markets in the US are pricing in a recession, and the stock market is not pricing in a recession. So that is the fight which is on every day. If you see, the bond yields are moving up and down, and the dollar keeps moving up and down, and some point comes which shows that US is not going into a recession or going into a recession. So the Fed will act, but I feel that this rate hike is done, and in case the 25 basis point in next week, and after that maybe another 25. So let's see. Now, even within in India, the April series saw a nifty up move of around 6.5%. Mid cap index moved up by around 8.5, and small cap went by 11%. So all the portfolios are nowadays looking nice, good. People are happy. I think among the results, Infi was the only major accident. Rest of the results are better than expectations. And mid-cap IT has shown good QoQ quarter-on-quarter growth. Like I saw among them, the two which I found were really good. One was KPIT, and the second has been Coforge, whose even constant currency growth is above 4% and all that. And KPIT is somewhere close to 7-8%. So that is very good, and the guidance is good. So actually, there is no point in bottom fishing in large cap IT. I feel right. We must go for mid cap IT stocks and look for outperform. And Cyient also was good. Now, what I would say is when I mentioned for be careful with capital allocation, like at these levels, if you buy stocks and in large quantity, this is very risky right now because chances of making gain are less as everything is priced to perfection as on date. So there are no huge surprises which are coming. Most of the results which are there are meeting the expectations. So there are no positive surprises. Only thing is that somewhere where expectations are less, the stock prices are going up. So I would try to sell my expensive stocks from here. This is what I want to do from here. Wherever we these are the in good times, we must get rid of all the weeds in our portfolio. Okay, and I feel FMCG is looking strong, as we saw with good results from Nestle and I think Britannia. And bank results are good. Yesterday's Kotak, IDFC First, all results are good. Even I think PSU banks are coming up with good results. So I'll just show the Nifty chart. If you see the retracement from the high in December of 18,862 to the low of March of around 16,823. So we have reached the 61.8% somewhere retracement of that fall. So we have covered that, and now we are making higher highs and higher lows. So uh, I think in the next this month or so, we should move from here to around this level of 78.6% retracement. That is 18,400, somewhere around that. And I think 18,000 would be a base unless there is a major thing wrong. Nifty is, if you see RSI, is slightly overbought. Okay. Now let's see Nifty Bank. Nifty Bank from the same fall has gone across the 78.6 retracement level. And in my view, I think we may be going and crossing the all-time high of around 44,000 odd in this move. Though RSI is slightly overbought, so we'll see. But the results are good and the momentum is there. So any dip here is a buy. Okay, let's see certain charts. I was talking about FMCG. See the ITC chart, right? It is above all moving averages and it is making new highs. Despite, and if you see in the last 1 year or so, the retail has sold it and institutions have bought it and it is going up. And the same thing is happening with Nestle. Nestle had a beautiful performance on Friday. So these are all going up. Now here if you see the Nifty Mid Cap 100 index, it is also breaking out from the declining trend line. So again, this is positive as I showed that it was in April, it was up around 8.5%. Similarly, the Nifty Small Cap Index is also breaking out from the declining trend line and it was up around 11%. So, pretty positive thing with the broader markets performing well. Now, the main topic today, when I was going to cover about the how to read a balance sheet. So, just general information. The balance sheet provides information on a company's resources, assets, and its sources of capital, that is equity and liabilities oblique debt at a specific point in time. It's a building block, provides any warning signals things are going wrong. You can assess a company's ability to pay for its near-term operating needs, meet future debt obligations, and make distribution to owners and all that. So what is an asset? Asset is what you own, which will generate a positive income for you, and liability is something you owe. So we'll cover it in detail. I'll show you the balance sheet of Tata Steel, and we will go through with that. There is a basic equation of balance sheet by which it is seen, which is that assets should be equal to liabilities plus owner's equity. We'll go through that also. So, based on the balance sheet, income statement, and cash flow statement, we can analyze certain ratios to understand the health of the business. Okay, let's go ahead. What to see in a balance sheet? Assets, that is current and non-current assets. I'll just show you with the help of this. This is a Tata Steel March 22 balance sheet. Assets, either non-current assets or current assets. These are divided into two parts. Current assets are which are likely to give you any income within next 1 year, and anything beyond 1 year is non-current assets. Okay, liabilities, again same, current and non-current. I'll show you with the same Tata Steel. Liabilities, if you see non-current liabilities and current liabilities, same thing, which are which you have to owe, which you owe or you have to pay within next 1 year is current liabilities, and which you are going to pay after 1 year is non-current liabilities. And equity is share capital plus reserves and surplus. So it is part of liabilities. Here the equity comes into play, equity, share capital, and other equity, that is the reserves and surplus which the company has accumulated over a period of time. This is all accumulated profits every year. They go into this part. So now, as we see, one of the important ratios to be seen is debt to equity. So the most important part is that what is the ratio between debt and equity? Where will the money to service debt come from? Higher is bad, and lower is better. Above 2/3, not 2/3, but 2/3 is risky debt to equity ratio. And but generally, IT companies are asset light, so they have low debt. But manufacturing and steel companies, they have high debt. Now let's see the debt to equity of Tata Steel. Okay, let's see. So in terms of debt, I have added this borrowings from here, non-current and lease liabilities, and from here, current liabilities again borrowing and lease liabilities. Okay, and equity we have here, that is 125,433. These are all in crores numbers. So to see, the debt as on March 22 was 36,524 crores and equity was 125,434. So the debt to equity ratio was 0.29, which was healthy. So that was good point to check. Next issue which one can check is the interest coverage ratio. That is EBIT upon interest expenses. Higher the better. Because if your operating income or the EBIT, earning before interest and taxes, is higher than the interest expenses, then you can take care of your payments easily. And low interest coverage ratio indicates that there is a possibility of bankruptcy if it is below 1. So we will see in the this for this we have to see the profit and loss account. Now let's see from here. This is of These are quarterly ones, and this is of financial year ending March 22. So if you see the EBIT is profit before tax. This was 44,090, and finance, and we will see the interest payment, which is basically finance cost. Finance cost was 2792 crores. So now let's go back. So EBIT was 44,000 crores. Interest cost 2792. So interest coverage ratio comes to around 15.79, which is again decent, good, not bad. Okay. Now let's see other parameters which you should see. Next one you should see is asset turnover ratio. That is net sales to total assets. Higher the better. It shows productivity, how well the company is using its assets to generate revenues. And low asset turnover ratio shows unproductive assets. So let's see again this next in terms of net sales and assets. Uh, just a minute. Anybody? Okay. So net sales 130,473, assets 221,986. So we will see in terms of revenue from here, profit and loss account. Total income 130,473. Okay, and total assets 221,986. So net sales 130 lakhs, assets 221 this thing this thing. So asset turnover ratio is 0.59. So it is not good. It shows that it is not very productively using its assets. Some assets are not generating revenues. So so the company is having too many assets or not using all the facilities adequately. Okay, next is a current ratio, which is current assets upon current liability. Now, higher the better. It basically indicates current assets are which will going to generate revenue for you within 1 year, and where you have to pay within next 1 year. So, what it generates, what it shows is that are you good for short term to take care of your expenses. So, here if you see, I'll again show you current assets and current liabilities. Current assets 31,289. Current liabilities 53,664. So if you see current assets, current liabilities, current ratio is 0.58. So what it shows is that your current liabilities are more than the current assets. So company may have to take some working capital loans or something like that, or sell some assets to generate cash in short term. So this is again a negative because it should be good, better. The other issue is we see is return on equity. That should be greater than around 15%. So return on equity is equal to net income upon total equity. That is profits in excess of cost of capital, and which leads to cash flows. So we will see again here net income upon total equity. Equity we have seen earlier 125 434. Net income we will see again from the profit and loss account. Net income is here. Net profit we reach here for total comprehensive income for the period 33706. So and total equity we have seen. So 33,706 net income upon equity. So if you divide it, you will get an ROE of 26%. So that is very good. That is why everybody was very gung ho on Tata Steel during this time. Now also all balance sheets have footnotes where there is something called contingent liability which we must see. This has to be paid if certain conditions are fulfilled. That is, you see, there is some issue which is cannot be put, but say you lose a court case and you have to pay something to some institution or some other company. So that is a contingent liability. We need to see this, or some cost which is not there in part of the balance sheet or profit and loss account till date. So these are the things which we must see. So as I've shown you balance sheet, the assets column, the the liabilities, equity and liabilities column, a profit and loss account. So I have finished. Is visible, sir?
Yeah.
Okay.